In this video, we're going to talk about when having a mortgage on your personal residence is a good idea and when it's a bad idea from a financial standpoint. This conversation really turns on the age-old discussion of good debt versus bad debt. I think we all know by now that things like credit card debt are a really bad idea and that we never want to have a situation where we're accumulating large outstanding balances on our credit cards. But the real problem is that all the financial advice we're taught assumes that everyone is irresponsible and not disciplined with their money. But the wealthy have long used debt to their advantage, and it can be one of the greatest wealth building tools that's available to all of us. So I'm going to use an example we're all familiar with, which is how mortgages on our personal home work, to illustrate to you when debt can be a good idea and when it can be a really bad idea. When we talk about mortgages, we should start with how conventional wisdom teaches all of us about the way we should handle our finances when we graduate college and first start working. We are all told to save as much money as possible. Most people do this by putting aside a portion of their paychecks into a savings account. We work hard for many years and we build up the balance inside that account. And once we have enough money, we go out and look for our first starter home that we can buy. In many cases, this could be a newlywed couple that are combining their savings together. But whatever the situation, we're told to go out and find a home where we can afford the down payment and then get a mortgage for the rest. We make sure we can cover the mortgage payments that we owe to the bank every month. And we're told to pay off that mortgage as quickly as possible. If you happen to listen to Dave Ramsey, you might actually even be making double and triple mortgage payments to pay down that mortgage more quickly than you need to. I think this fact pattern, which is how we're taught that responsible people should act when they're first starting out, perfectly illustrates how bad of a job we've done in this country at teaching true financial literacy. I also think it might be one of the many reasons there are even further and further discrepancies between the wealthy and the middle class. Yes, I absolutely agree that there are plenty of situations where having a mortgage is a good idea. I would actually advocate that responsible investors should keep as little equity in their homes for a number of different reasons. But the newlyweds in the fact pattern that I described shouldn't have gotten a mortgage. And I'm going to explain to you why that is by talking about when a mortgage is good debt and when it's bad debt. Let's start with talking about what is bad debt. Bad debt is when you can't afford the thing you're buying, so you take out a loan to allow yourself to purchase it. The classic example that I alluded to at the beginning of this video is going into credit card debt for something like to pay for a vacation or buy new clothes. The person just keeps paying the minimum payment each month and they continue to rack up higher balances more than they can afford. This becomes a vicious cycle, and you can easily see how people can get themselves into trouble, particularly when you look at the high interest rates that banks charge on these outstanding credit card balances. The second example of bad debt in the mortgage context is where you have an example that I discussed before with the newlyweds or someone who's just starting out from college. You saved enough money to afford the down payment, and then you take out a mortgage for the rest to purchase the property. So you might have $40,000 in savings, for example, and you put down that minimum 20% down payment on a new house that costs you $200,000. If $40,000 is all that you have, you can't afford that home. You're just using a bank loan to purchase a home that you can't otherwise afford. And this is a bad idea for a number of different reasons. This person should not use a mortgage to buy a home because they can't afford the home in the first place. So the mortgage in this scenario is bad debt. So now that we've covered what bad debt is, let's talk about when debt can be a good thing. Good debt is when you're using debt to create efficiencies for purchasing something that you can otherwise afford. So let's think about the first example with a mortgage. I have $1 million in savings that I have invested in different assets, and I want to buy a $200,000 home. So I put down the minimum amount that I have to on that home, $40,000, and I use a mortgage to fund the rest of the purchase price. So instead of taking $160,000 of my savings to pay for that home in full, I'm going to keep that money invested in an asset like the stock market. Another example of using good debt is when you're buying a business. Say I have a $2 million net worth and I want to buy a business worth $500,000. It might make a lot more sense, economically speaking, to use something like an SBA loan to purchase that business than to pay cash for it in full. Or I might do something like take out a loan against my stock portfolio to fund the down payment or purchase price for the business instead of selling assets. So there are all kinds of ways that you can use debt to your advantage to buy assets that you could otherwise afford to pay for in full. Let's dive into what I mean when I talk about using good debt to create efficiencies and what those efficiencies might be. The first and most obvious is the efficiency around investment returns. There can typically be investment return efficiencies or arbitrage plays when you are using good debt. Here we are talking about opportunity costs and putting our money to the best use possible. If you're someone who's responsible with money and you have a good credit rating, you can probably get a really low interest rate on that $160,000 mortgage. So the smart investor is going to invest that $160,000 in an asset that's kicking off much higher returns than the interest charged on the mortgage that you have to pay the bank. So you're ahead the difference there, and that's what we mean when we say it's an arbitrage play. The last thing you ever want to do is have a bunch of equity in your home just sitting there. Efficiencies around good debt can also be tax efficiencies. So think about something like a loan on a real estate investment property. You get a tax deduction for the interest on that loan. So that's going to create a tax benefit and further reduce the after-tax interest rate you are paying on that loan. This will also further increase your investment return efficiencies that we just talked about before. There are also many cases where you can use debt to avoid having to ever pay income tax on the appreciation in your assets because you can use debt instead of having to sell those assets and generate the cash. Debt can also provide good asset protection benefits as well because it makes you an unattractive litigant and might limit your exposure in future lawsuits. If you live in a state that doesn't offer a full homestead exemption, you likely don't want a situation where you have more equity in your home than the homestead exemption covers. Now, you may be saying to yourself that this all sounds great in theory, but it isn't realistic because no one can wait until they have $400,000 or $1 million in savings to buy a home, especially with the cost of living these days. But you absolutely can continue to rent a home. We've just allowed ourselves to be convinced that the American dream is home ownership and that renting is a waste of money. But I think anyone with even a basic understanding of finance knows that's not really the case. I've never understood why on earth we need to buy a home to live in before you even have kids. I feel like this whole starter home idea was just something the real estate brokerage industry came up with. If you're buying a starter home, it's almost always something more expensive than you need for many years in the beginning, or way too small for what you need for many years before you can sell and move to a bigger home. Many of the wealthiest young people I know who didn't just inherit all their wealth still rent. I still rent. And I don't foresee a situation where I will ever buy a home in New York City. It just doesn't make sense. I love the home that I live in, and I'm happy to live here for the rest of my life. Now, I'm not trying to say that if you use a mortgage to purchase a home before you can afford it, that you'll never be wealthy. I know plenty of wealthy people that have done this. But in many cases, you will find that it took them a lot longer than it needed to for them to accumulate that wealth. And you will find that many of these people didn't really become wealthy until they were in their late 50s or early 60s at best. And the point that I want you to get from this video is not that you have to be 100% perfect with your money. We do not have to be correct every single time. But what I do want you to understand is how these principles work so that you know how to think about them the right way and that you can understand what is good debt and what is bad debt. So make sure that you subscribe to my channel so that you can keep learning about how smart investors think about money.